Hi and welcome to the video on Nifty and Sensex. The Nifty 50 and Sensex are both the indices that track the performance of overall stock market. The Nifty 50, also known as the NSE 50, which is National Stock Exchange 50, is a benchmark index composed of 50 of the largest and most actively traded stocks listed on the NSE, while the Sensex or the Bombay Stock Exchange Sensitive Index is a market index consisting of 30 of the largest and most actively stocks traded on the BSE. The Nifty 50 and Sensex are widely used indicators for the overall health of the Indian stock market and are often used by investors, analysts, and the financial media to gauge the performance of the market. Both indices are made up of the basket of stocks representing various sectors of economy such as finance, technology, healthcare, and are calculated based on the free float market capitalization weighted methodology, which means the level of each stock's representation in the index is determined by its market capitalizations and the level of outstanding shares available to the public. So, if share price of company listed on Nifty or Sensex increases, the value of index will also increase. Similarly, if the share price of company listed on Nifty or Sensex decreases, the value of index also decreases. For example, if the share price of company listed on the Nifty increases by 10%, it will have a greater impact on the value of index if company has a higher market capitalization compared to the company with a lower market capitalization. Nifty 50 and Sensex are both reviewed and rebalanced periodically to ensure they continue to represent the performance of market accurately. Changes to the indices are made based upon a variety of factors, including the liquidity, financial strength of the company included in the index, as well as the overall demand of the stock. The Nifty and Sensex are both calculated in real time, meaning they are constantly changing as the stock price of the companies in the index change. If a company's stock price increases, it will have a greater weightage in the index and will have a greater impact on the overall index value. Similarly, if the company's stock price increases, it will lower the weightage and smaller the impact on the index value. So, if Nifty and Sensex increases, it means that overall stock market is performing well and the value of companies and index is increasing. On the other hand, if Nifty or Sensex decreases, it means that overall stock market is performing poorly and the value of companies and index is decreasing. So let's now discuss the benefits of Nifty and Sensex. So first one is the market performance. Both Sensex and Nifty are the key indicator of the overall performance of the Indian stock market. By tracking these indexes, investors can get a sense of how market is doing and make informed decisions about their investments. Diversification is the second point. So both Sensex and Nifty includes a diverse range of companies from different sectors, which helps spread out the risk of the investor. The diversification can lead to the more stable returns for the investors. The third one is benchmarking. Nifty and Sensex can serve as a benchmark for investors to compare their portfolio performance to the overall market. This allows investors to see how their investments are performing relative to the market as a whole. The fourth one is liquidity. Both Nifty and Sensex represent a large portion of the Indian stock market, which means they are highly liquid and easy to buy and sell. This makes it convenient for the investors to buy and sell these indices. Now let's discuss what are the cons for these indices. While Nifty is considered a good benchmark for the overall performance of the Indian stock market, there can be some cons to consider. One con is Nifty is highly concentrated in certain sectors. For example, financial and IT sectors make up the large portion of the index, which means if these sectors are poorly performing, it can significantly impact the overall performance of the Nifty. The lack of diversification can be risk for investors. Another con of Nifty is that it's not necessarily representation of the overall economy. While it includes some of the top performing companies in India, it may not be accurate reflect of the performance of the smaller or the mid-sized companies or sectors which are not included in the index, such as agriculture or manufacturing. Now let's move to Sensex. So Sensex is another benchmark as we discussed in Indian stock market, which consists of 30 companies. So one con is like similar to the Nifty, which is concentrated. This lack of diversification and can be risk. So another con can be based upon the market capitalization, which means that companies with a higher valuation have greater impact on the index. This can lead to the bias toward larger and more established companies rather than smaller and upcoming companies. Investors can track the performance of Nifty 50 and Sensex through the financial news outlets and various financial websites and tools such as stock market tickers and financial charts. The stock market can be volatile and the value of Nifty 50 and Sensex can fluctuate significantly based upon the variety of factors, including economic conditions, company earnings, global market trends. They are often used as a benchmark to measure the performance of the mutual fund and other investment vehicles. So, in conclusion, while the Nifty 50 and Sensex 30 are the useful benchmark for the performance of the Indian stock market, it's important to consider pros and cons of each index while making the investment decision. It's also important to track the latest developments in the stock market and to stay informed about the companies in which you are investing. I hope you like this video. Thanks for watching. Nikhil Dhawan signing off.